Good afternoon, everyone. We thank you all for your time today to attend our webinar on an interesting topic, which is in the minds of equity investors, thanks to SEBI. We hope you'll find the session informative as well. Before we start, we would introduce our company, Trustline Holdings, and the key speaker for the session. My name is Govindarajan. I take care of new business development in Trustline. Trustline Holdings is a 2-decade-old SEBI-registered alternate asset management company based out of Chennai. We are a small cap specialist and a meticulous practitioners of value investing. We are glad to share that recently our asset under management crossed 1,000 crores. We have built an enviable client base of C-levels numbering to more than 600. Today's session is going to be anchored by Mr. Arunagiri, who is a founder, CEO, and Chief Investment Officer of Trustline. Arun comes with more than 2 decades of small cap investing experience. The session will last for about 45 minutes, including 15 minutes for Q&A. Over to you, Arun.
Thanks, Govind, for a very quick and short intro. Let me also thank all of you for taking time off on a weekend to participate in this seminar. Really appreciate that. I'm genuinely excited to present this topic, very interesting topic. Will the markets turn stock specific in small caps, small and mid caps? So that's going to be the topic. This topic is interesting for a couple of reasons. One reason is the recent turmoil in small caps, thanks to the overhang, regulatory overhang and SEBI strictures, has led to some sort of weakness in small caps. Now, investors are grappling with this question, whether this weakness, the recent weakness because of this turmoil, will it lead to a bear phase like what happened in 2018? Is it start of a bear cycle? That's a question which investors are grappling with. That's one reason why it's interesting. The other reason is, given the strong macro outlook and the benign, interest rate cycle outlook, even if the correction happens, can it last longer? Will it be an extended correction? Before we get into more details on this, let me set the context in terms of the current market setting. The best way to understand the current market structure is to look at, for the past 3 months and look at how the markets have played out in small mid caps for the last 3 months. And probably what we can do is we split these 3 months into 2 segments. One segment in which, you look at the returns in Jan and February, and then look at the March returns in the second segment separately. So if you look at the Jan February returns, the small cap index has delivered a positive returns. It hit a new lifetime high in February. And for the 2 months together, it has delivered a return of close to positive 6% return. Then this turmoil happened in March. So if you look at March in isolation, the returns are negative for small caps, close to about 5%. And if you look at from the peak, it has fallen close to about 10% post this regulatory strictures. So that's a kind of setting for the market. Now the investors are genuinely wondering whether this recent weakness, whether the recent correction in small caps, will it be a start of a new bear phase like 2018? The reason why it sounds very very similar to 2018 is because in 2018 we had a similar situation. Just in 1 year of 2017, small cap index had delivered close to about 50% return. And in the following year, 2018, the correction started and the small cap indices went all the way down by 30% plus. So the fear is in all investors' mind whether this recent correction is the start of such a massive, down cycle for small caps. That's a question investors are asking. They're also wondering whether this will be, this will be such a sharp price correction, or will it be a shallow correction, or in case can it be a time correction? If it's a time correction, how long it's going to extend? Will it be a prolonged time correction, or will it be a short and shallow time correction? So these are the questions which investors are asking and they are grappling with. The best way to look at and find out answers for this is to go back and look at past correction cycles, down cycles, and look at what triggered them and whether there were any common patterns across these cycles. So you had in the last 2 decades, you had 4 or 5 down cycles. You had 2008, which was hit by global financial crisis, which was a sharp downturn. Then you had 2013, which was triggered by policy paralysis of UPA government. Then you had 2018, which was triggered by rate hike cycle as well as a blowout in some of the financial institutions in India. Then you had COVID crisis in 2020. So you had 4 cycles. If you look at all the 4 cycles, you will find something common across all of them. The common denominator in all of these were some sort of macro event risk or some sort of rate hike cycles, start of a rate hike cycle. So these were common denominators in addition to expensive valuation for the broader market. Now, if you look at the current cycle, of course, you have an expensive multiple for the broader market. Small and mid-cap indices are trading at a historically very high valuations in terms of multiples. But the other ingredients, critical ingredients like your macro event risk or the start of a rate hike cycle are missing in this particular time. In fact, contrary to that, you have a very robust macro outlook for India, as well as for global outlook in terms of, even the recession fears for US is behind us. In addition to that, we are now staring at a start of a rate cut cycle. So if you look at the recent pronouncements from Fed, they are hinting at 3 rate cuts in this calendar year. So given this kind of a macro outlook, robust macro outlook, and start of a rate cut cycle, in our view, it is unlikely that you will find a very sharp price correction in the broader market. At the same time, since it's trading at a very expensive multiple in the broader markets, the markets are likely to move into a trading range or kind of a consolidation, with markets actions shifting to stock specific segments. So if you are in the right stocks and if you have picked the right stocks, it is still possible for investors to eke out returns in this difficult market. So it will be a market which will delight stock pickers. That's our view. There's another reason why we think the markets will turn stock specific is also because of the nature of the expansion in this particular cycle for India. This particular expansion is eerily looking very similar to 2003 and 7 cycle. If you go back and look at 2003 and 7, the expansion was led by investment. If you look at the investment to GDP ratio in 2003-07 cycle, it was at a low point of 26-27%. It went all the way to about 39% when in 2008, when the global financial crisis hit. And it stayed at that 39% till 2011, post which it started declining, and you had this decade of investment collapse, which happened post 2011 up to 2020. Now we are starting at an inflection point where from 2020 low, it has started moving up, the investment to GDP ratio. Now it is close to about 34%. The consensus estimate is that this 34% will slowly move towards 36% by FY27. So this particular cycle, it will be led by investment. The initial part of the investment cycle has been led by the public capex, which is, as all of us know, which we keep highlighting in many of our, communication, is that this particular ruling regime has increased the government capex of GDP as a proportion of GDP from about 1.6, 1.8% about few years back to close to about 3.4% of GDP in this interim budget for FY25. That's an estimate for FY25. So there's been a sharp increase in terms of capital allocation for infrastructure and capex projects by this regime. So basically, this investment expansion cycle has been led by public capex. But now the baton will be handed over to private. The reason being the corporate profitability in terms of ratio profits to GDP, which was around 1.6%. In 20, it has moved up to close to about 5.3% last year. As a result, corporates will start investing, and one is already witnessing the early signs of private investment turning. And so given this kind of robust macro outlook, which is led by investments, which will again percolate down to consumption demand on a lag effect over a period of time, investors have to, especially the investors who are waiting on the fence in terms of when to invest, should we wait for a sharper price correction, probably will have to navigate this market without waiting for a sharp price correction. The reason why it is very unlikely that you will have a sharp price correction is because the macro triggers, which we talked about in the beginning in terms of event risk or the rate tightening cycles, which are the key ingredients for a sharp price correction, is missing in this particular time. You have only one of those three ingredients, which is expensive trading multiple, which is there, but the other two are missing. So it's unlikely that the markets are get into a similar bear phase like 2018, where the small cap index saw a big decline of about 30%. So in this kind of settings, investors are left with no option but to look at systematic investments in mutual funds, or look at funds like ours, which deploy in a very phased and cautious manner without putting money lump sum at one shot. That's what we would say. That's what we would encourage investors to do instead of waiting for a very sharp correction, because that will lead to disappointment for investors, because you don't have a big macro risk triggers which can lead to a bigger correction in the broader market. In summary, what we look at is, it's very unlikely that this particular correction, which has been triggered by this turmoil in small caps because of the regulatory overhang and because of the SEBI strictures, is unlikely to be a beginning of a bear phase like 2018, because you have a very robust macro outlook and also a start of interest rate cutting cycle. Given this, I think it is a market which will be more of range bound, which will turn into more stock specific, and it will be a market which will be a delight for stock pickers. That's what I would summarize. With this, let me conclude my initial talk, and probably we can open the floor open for Q&A from our participants. Thanks a lot. Thanks a lot for participation once again. Thank you.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.